You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. And today, my goal is to break down two different ETFs listed on the Australian Stock Exchange with you. Now, I'm going to discuss two ETFs that both have 100 holdings, both give great international exposure for around about the same management fees, and we're going to discuss the different companies that these index funds track, or these ETFs track, and we're going to discuss why you might want to hold them in your portfolio, okay? Because there's a lot of great things they can provide the investor. So these are, of course, the iShares Global 100 ETF, IOO, and the Betashares NASDAQ 100 ETF, NDQ. Now, both are quite similar in the companies they hold, especially in the top 10 holdings. We're going to discuss a little bit about those companies today, and why, even though that they are listed in the NASDAQ or the United States Stock Exchange with the Dow index, you actually get exposure to other countries just by where they operate their operations, where they receive income from, etc. So, you know, companies like Google earn advertising revenue from all over the world, for example, not just in the United States. So we're going to break this down now. So I'm going to show you firstly the iShares Global 100 ETF, IOO. Now, when we're looking to buy this one, you can buy it on any brokerage site that lists in the Australian Stock Exchange. So, you know, CommSec, Pearler, Self-Wealth, my personal favorite, link in description if you want to try that out. And you just buy this like a normal purchase of shares, okay? And this gives you exposure to this ETF. Now, this has a management fee of just 0.4%. So on a $10,000 investment, your management fees are going to come out of your distributions and performance of just $40, and that's on a $10,000 investment. So that's a very low fee to pay to receive that sort of yield, okay? So we're going to scroll down a little bit. Now, the investment objective of IOO is to provide investors with the performance of the S&P Global 100 index. This is before fees and expenses. The index is designed to measure the performance of 100 multinational blue chip companies of major importance in global equity markets. So, why would you potentially buy the fund IOO? You get access to 100 of the largest global stocks in a single fund. It uses international diversification to seek long-term growth opportunities in your portfolio. And basically, it's a fantastic way to get exposure to United States companies and companies from all over the world, which are not requiring you to have international brokerage accounts, etc. You know, you can buy this all within your brokerage accounts that you have here in Australia. You don't have to worry about foreign exchange fees and all of that jargon before you make the purchase. You can just simply buy it in your current brokerage. So that makes things very easy. Now, when we're talking about IOO, basically this management expense ratio keeps it very affordable to purchase these companies. We're going to scroll down here a little bit now, and we're going to talk about the returns. So the benchmark is the index returns that we're looking to track, okay? And if we look at the last 1, 3, 5, and 10 years between the index and the total returns of the market, you know, they are quite well aligned. And since inception of these two funds, they have been identical at a annualized return of 4.16%. Obviously, had you held IOO from last year during the market dip for the global pandemic, you would have seen about 30% returns, 30.34 versus 30.35, which is a fantastic return for 1 year. But as you can see, the last 3, 5, and 10 years have all been over 15%, which is just a fantastic return to try and aim for. With a 15% return, your money is going to double through compounding interest every 5 years or so. So it would not take you long to build some very good wealth in the long term, okay? So when we sort of like discuss this ETF and how it's performed, this is taking into account the increase in value of the asset and the dividend returns, okay? Now, with our IOO fund, the distributions are paid biannually or semi-annually. So you receive a dividend in July and in December, which is really good because we want to receive our dividends on regular basis and have them reinvested just to compound and grow the amount of share units we hold, which over time obviously increases our exposure to these companies. as we kind of accumulate more shares, okay? So the net assets under management, we have 2,400,428,313.69. So it is very, there is a lot of money behind this fund, showing you that it is quite safe and a lot of people trust it and want it in their portfolio. Like I mentioned before, the distribution frequency is semi-annual, and this fund was incepted on the 5th of December in the year 2000. It was listed on the Australian Stock Exchange back in 2007, however. So before that, it was a closed fund that you had to buy through your iShares broker. Now, we're going to scroll down here. If we look at the rebalance frequency of this index, it's only quarterly. So you're only having the capital gains events triggered every 3 months within that fund, okay? Obviously, some of those profits will be passed on to the shareholder as a distribution, but any losses are kind of worked into the fund with its returns, okay? Now, this fund technically has one holding, but the fund is the Australian stock, the fund is the IOO Global 100 ETF, which is a separate entity to what is listed on the ASX. However, it is the same product, it just holds itself, which then holds the underlying assets, okay? And I'll show you those shortly. So, the portfolio characteristics, we can see here, the 12-month trailing dividend yield is 1.35%, but obviously, when we have a inflated asset price with a consistent dividend yield, the higher the price goes, the lower the yield looks. If that price comes down, the yield looks higher, okay? So that's actually a very common thing to have happen, especially after a 30% gain in a single year. Now, none of these are, none of the last data really matters, but if we look at the underlying holdings of the iShares Global 100 ETF, you can see some of these companies are household names, okay? The biggest holding within the fund is Apple. Now, this is listed on the NASDAQ, and so are many of these companies we're about to discuss, but we're just going to really focus on the top 5, to be honest. So we've got Apple, we've got Microsoft, we've got Amazon, we've got Google Class A and Google Class B. Now, all of these shares are, or these top 5 are household names. Most people have access to Apple computers or Apple phones. We use AirPods, a lot of people use Apple Music, and some sort of other Apple service in their life. Even if you're like me and you predominantly stick to Samsung products, you've likely encountered Apple, used an iPod before or something in the past, or you know somebody with them. Microsoft, this company has all of our Microsoft Word, Excel, PowerPoint. Most computers run on a Windows product. There's so many different income streams within Microsoft, and they earn money from all around the world through different subscriptions, like for their Word products, through sales of computers and hardware, etc. So Microsoft is a money machine. The next company is Amazon. Now, this is obviously consumer discretionary. We're selling products, we're delivering items. Then they have their streaming services, Amazon Prime, Audible, and all of these other sort of direct to customer services that are provided. Anyone who uses Amazon to shop, stream, or listen to audiobooks, you literally don't have to leave your house, and you have access to the entire world at your fingertips. So Amazon makes money from all over the world. They ship items internationally, allow people to become business owners by selling and distributing products through Amazon, and they provide basically a stepping stone forwards for anyone to make a successful business online. It is an amazing company, and I can't imagine anyone ever betting against Amazon in the future. The next 2 shares are Alphabet Class A and Alphabet Class C, which are both Google, okay? Now, these 2 different, classes of shares just equate to essentially the value of the share is different, so you can buy into Class C easier than you can buy into Class A, and one of them comes with the voting rights and one doesn't. So if you're going to buy a Class A, you then get to put your votes in when there's a board meeting or something like that, and decisions about the company are being made. Class C just means you don't want to really worry about the happenings of the company, and you just want to passively own it. But Google is one of the greatest money printing machines that has ever entered the world. So Google sells advertising space. They obviously have a lot of advertisements within websites. They get people to the top of a search engine so that companies may actually pay to reserve their spot in the search engine. They have YouTube and advertising through that. And they have all of these different services they provide, which just print money, print money, print money. If there's the perfect business model out there, I would have to say Google must be close to it, because I can't see where there's any fault for them. They have content creators come to them and post blogs, and then people want to advertise on those blogs, so Google takes money from that. They have content creators uploading things to YouTube, just like I'm doing now. Not that I'm monetized, but eventually people start to see these content creators and want to see them, so then advertisers want to put products onto their pages, have their videos kind of play an advertisement before the video starts, and Google takes that money. So every time you skip a video on a YouTube ad or something like that, you're essentially stopping that content creator getting paid as much money as they would have. So it's not a bad idea to every now and then let a full video play. And if you look at pages online or on YouTube, such as Graham Stephan, Andre Jick, Meet Kevin, they all have a little bit of advertising on their videos. So once it plays, you watch a short video and then you get this amazing free content. But the way we pay them is by watching these ads. Google is a powerhouse. So as you can see, the Global 100 ETF from iShares holds a lot of these absolutely amazing companies. And if we look down a little further, you know, there's Johnson & Johnson, Nestle, Procter & Gamble, Samsung Electric. So all of these absolutely massive companies, which everyone around the world has had exposure to in one way or another. I highly recommend owning a fund that's as diversified and low cost as one like this. Now, it's pretty cool. You can see here most of the exposure of IOO is through the United States, and then we have a little bit of exposure to other markets throughout the world. But as you can see, even though a lot of these funds or these companies, are from the United States, they have earnings and workings all over the world. So it's not like buying IOO is only giving you exposure to the United States. Okay. Now, I must say the total returns of IOO as a fund have been really good, and you really can't go wrong earning about a 15% return over 10 years annualized. That's fantastic. So now we're going to look at the NASDAQ 100 ETF or NDQ. This is provided by Betashares, and this is also a fantastic fund to hold in your portfolio. Alright, so the Global 100 ETF, NDQ, which is the top 100 companies within the NASDAQ provided by Betashares. This is a very cool fund, okay? So the fund objective, NDQ, aims to track the performance of the NASDAQ 100 ETF index before fees and expenses. The NASDAQ 100 comprises of the 100 largest non-financial companies listed on the NASDAQ market and includes many companies that are at the forefront of the new economy. So basically, NDQ has the biggest tech exposure through those 100 companies out of all the ETFs you can sort of get, because they're not diversified into other sectors. It's very heavily focused on the tech sector. Now, the management expense ratio of NDQ is 0.48%, and because it's holding mostly United States companies and companies from all over the world, all of the tax components and all of the forms you would normally have to fill out, like the weight band forms, they are actually handled by Betashares. So you don't have to fill out any forms to get your Australia domiciled returns. Now, what we're going to look at is the current price of NDQ is $32.79. And that's kind of getting you exposure to the ETF a little cheaper than what the iShares Global 100 is. However, it really doesn't matter what you pay per unit. What matters is the underlying assets. However, psychologically, this may be an easier one for people to stomach than a $100 share, especially if you're first getting into shares, sort of you're brand new to the process. It can be a bit scary to buy a $100 share, so maybe something like this you can stomach a bit easier. Now, the assets under management, okay, are $2 billion, 166,350,128. So as you can see, even though this is a bit of a newer fund, it's still starting to accumulate a lot of assets. Very similarly to IOO, this has a semi-annual distribution or biannual. You can elect to have DRP, so your dividends are just reinvested into new shares, which grows the holding, the amount of units you hold, which over time compounds, okay? Now, we're going to come down a little further. So, of the top holdings, okay, so this is the top 10 it's showing, but again, we'll focus on the top 5 or 6. We have Apple, which we've already discussed, Microsoft, Amazon, Alphabet, but the 5th holding is not Alphabet class C, it is Facebook. So Facebook is another advertising space giant, just like Alphabet or Google, which gives you exposure to 4 of the largest social networks in the world. Okay, so we've got with the company Facebook, we've got exposure to Facebook, Instagram. You then also have WhatsApp and the Messenger app, and in fact, there's about 1/4 of the entire world's population, so over 2 billion people using one of these services every single month. So that means Facebook is essentially grasping the entire population of the world and having at least 1/4 of them interact with their services every month. Therefore, they still have room to grow. Possibly not to 100% of people, because we still have issues where people don't have access to the internet and other things like that. But this is still a fantastic company for international exposure. They earn revenue from all over the world. They provide advertising space and a place for people to create real businesses. And Facebook is basically one of those things that has a network effect. So the more people that use Facebook and the services within it, the more, reliant on it businesses and individuals become. Therefore, their reliance on the product grows and Facebook gets stronger and stronger and stronger. The 6th company within the NDQ fund is Tesla. Now, Tesla is an electric vehicles manufacturer and distributor, but also has a lot to do with the renewable energy space. So it's pretty cool that it also holds this, and as you can see, NDQ is very tech focused, okay? So if you would like a fund that gives you exposure to all of those sort of those companies that are going to have a real impact on the world over time, and you want exposure to a Tesla, a Facebook, and Amazon, this is pretty much the way to go. I can't see anyone looking past the NDQ fund if you want exposure to these. And as a bit of a disclaimer, I personally hold NDQ in my micro investing app Raise, not in my main brokerage account, so I have a small exposure to it and it has performed very well. Okay, now we're going to scroll down a little further. The sector allocation here, you can see information and technology is literally 50%, 49.3%, and then everything else kind of trails behind in much smaller exposures. Okay, so really that 50% exposure to info and tech is what you're focused on with this fund. Now we're going to look at the performance. So the 5-year performance rate, okay, is 27.64% in the index and 27.23% in the fund, which that's obviously just a difference which is created by the rebalancing kind of drag and also the fees which are taken out. So when we actually look at the returns, the 5-year returns are amazing, and your money would be doubling every 4 years, which is just a phenomenal return rate. The 1-year returns are 34%, which not even active investors can sort of beat that year over year, okay? Yes, obviously the returns are inflated because of the COVID crash we experienced last year and the ability to buy pretty much anything last year and earn a return. However, regardless of that, the previous 3 years, the previous 5 years since inception, we're always hitting over 20% returns, which is just phenomenal. You cannot go wrong with that. Even a 1 month return of nearly 5% completely destroys most ETFs out there, okay? So definitely worth considering this fund. Alright, so the distribution frequency is semi-annual and the 12-month distribution yield is 3.7%. Obviously the value of the fund has come up, so like I said before, the distribution yield is down, but that doesn't matter. The returns are encompassing both distributions and capital appreciation. So the last distribution was $1.17. The one before was 2 cents. So every mid-year, the July dividend always completely blows out the January dividend, and that's just simply because of the annual dividend frequency of some of the companies it holds, which means it's only on the second dividend payout per year that you really receive the bigger yield. So if you're chasing regular and predictable income, NDQ may not be the right fund for you if you're an income investor, but that's okay. So the annual distribution return, you can see for the last couple of years, is usually around that 3%. We've got an outlier here, and again in Jan 2019, but that's okay. Alright, so guys, that is the fund NDQ, and I hope you can see, while both of those funds, NDQ and IOO, have sort of a similar approach to tracking the top 100 companies of the index that they are looking at, it gives you great exposure to some powerhouse companies, and you're going to have this fantastic addition to your portfolio if you want international exposure, strong growth companies, which also pay a little bit of distributions. Alright, if you got any value from this video, please like, share and subscribe. Let me know, do you hold either of these funds, and what performance or what sort of returns have you been able to retrieve? And I really look forward to seeing you in the next video.